Are you tired of watching your savings sit idle in a bank account, earning next to nothing? Have you been thinking about investing but feel overwhelmed by the stock market, charts, and endless financial jargon? If that sounds familiar, you're not alone. And you're in the right place, because mutual funds might be the simplest and smartest way to grow your money without needing to be a finance expert. In this video, I'm going to explain what mutual funds are, the different types you should know, and the real benefits that make them one of the most popular investment options worldwide. So whether you're a complete beginner or just brushing up on your knowledge, stick around, because in just a few minutes, you'll understand mutual funds better than most people ever will. What are mutual funds? Let's start with a simple definition. A mutual fund is a professionally managed investment vehicle that pools money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. Instead of picking individual investments on your own, you invest in the fund, and a fund manager does the rest. Imagine this. You want to invest in the stock market, but you don't know which company to choose. So, you join forces with a group of people, pool your money, and let an expert manage it by buying a whole bunch of companies. That's a mutual fund. When you invest in mutual funds, you're buying units or shares of the fund. The value of these shares rises or falls based on how the fund's investments perform. Now let's dive into the different types. Types of mutual funds. There are several types of mutual funds, each serving a different purpose. Choosing the right one depends on your goals, risk appetite, and investment horizon. Here's a breakdown. 1. Equity mutual funds, stock funds. These funds invest primarily in stocks. They're ideal for long-term wealth creation and can offer high returns, but with higher risk. There are subcategories like 1. Large cap funds. Invest in well-established companies. 2. Mid-cap and small-cap funds. Invest in medium and smaller companies with growth potential. 3. ELSS, equity-linked saving schemes, offer tax benefits under certain regulations. 2. Debt mutual funds, bond funds. These invest in fixed income instruments like government bonds, corporate bonds, or treasury bills. They're more stable and less risky than equity funds, perfect for conservative investors or those seeking regular income. 3. Hybrid or balanced funds. These funds invest in both stocks and bonds, offering a mix of growth and income. They're good for investors who want a balanced approach, less volatile than equity funds, but with more growth potential than pure debt funds. 4. Index funds. These aim to replicate the performance of a specific market index like the S&P 500 or NASDAQ. They're passively managed and come with lower fees. If you want to buy the market, this is a great option. 5. Sector and thematic funds. These funds focus on specific industries like technology, healthcare, or energy. High reward, but high risk. Great if you believe a certain sector is about to grow. 6. Money market funds. These are ultra-safe funds that invest in short-term debt securities. Returns are low, but the risk is minimal. Ideal for parking funds for a short time without locking them in. Each type has a different risk-return profile, so picking the right fund depends on your unique financial goals. Key benefits of investing in mutual funds. Now that you know the types, let's explore the benefits of investing in mutual funds. This is where they really shine. Checkmark 1. Diversification. Mutual funds spread your money across many different assets. So even if one stock performs poorly, others can make up for it. This reduces your overall risk. Checkmark 2. Professional management. You're hiring experts to manage your money. Fund managers monitor the market, research companies, and make decisions that individual investors often can't. Checkmark 3. Affordable entry. You don't need a fortune to start. Many mutual funds allow you to invest with as little as $50 or $100. And with systematic investment plans, SIPs, you can invest small amounts monthly. Checkmark 4. Liquidity. Most mutual funds offer high liquidity. You can redeem your investment at any time, unlike real estate or long-term insurance policies. Checkmark 5. Tax benefits. Some mutual funds, like ELSS, provide tax deductions under certain regulations, which can help reduce your taxable income. Checkmark 6. Automatic reinvestment. Any dividends or capital gains can be reinvested back into the fund, helping your money compound over time. Checkmark 7. Transparency and regulation. Mutual funds are heavily regulated and must disclose their performance, holdings, and fees regularly. This helps you make informed decisions and builds trust. Risks and what to watch out for. Mutual funds are not risk-free. Here are a few things you need to be aware of. 1. Market risk. If the assets the fund invests in go down, so does the value of your investment. 2. Management risk. Not all fund managers are equally skilled. 2. Past performance doesn't guarantee future success. 3. Expense ratios and fees. Some funds charge high management fees that can eat into your returns. 3. Always check the expense ratio. 4. Lock-in periods. Some funds have mandatory holding periods. 4. Make sure you're okay with that before investing. The key is to read the fund's fact sheet, understand where your money is going, and choose a fund that matches your goals and timeline. How to start investing in mutual funds. Starting is easier than ever. 1. Choose a goal: retirement, a house, your child's education, or wealth creation. 1. Knowing your goal helps pick the right fund. 2. Pick a platform. You can invest through brokerage accounts, bank apps, or dedicated mutual fund platforms. 3. Compare funds. Look at past performance, fund manager reputation, asset allocation, and fees. 4. Start small with SIPs. A systematic investment plan lets you invest consistently, build a habit, and benefit from rupee cost averaging. 5. Track and adjust. Check performance quarterly, not daily. 5. Rebalance if your goals or risk appetite change. So there you have it, mutual funds explained, from the ground up. Whether you're just starting out or looking to diversify your portfolio, mutual funds offer flexibility, growth, and simplicity. If you learned something new today, go ahead and like this video, subscribe to the channel, and hit that notification bell so you never miss our weekly insights on investing and personal finance. Drop a comment below. Have you invested in mutual funds yet? Or are you still exploring your options? Thanks for watching, and remember, investing is a journey. Take the first step today.